Thank you. So I have to say that I think the panelists so far are vindicating the idea that people in this VC world need to look at markets in a lot of the same ways that antitrust enforcers do. So it's been very stimulating. Our third panel will be moderated by Karina Lubell at the Justice Department, and it relates to investing in platform markets. Karina?
Great, thank you, Dave. So yes, my name is Karina Lubell. I'm an attorney advisor in the Competition Policy and Advocacy section at the Antitrust Division. And I have the pleasure of moderating this third panel, the topic of which is investing in platform-dominated markets. I think we all know that digital platforms are important. They facilitate transactions between buyers and sellers, users and publishers of content, and advertisers and consumers. And I think most of us would probably agree that these services have become an essential part of our society, resulting, not surprisingly, in a lucrative business for the firms that dominate these markets. So you might expect that the profits the dominant tech firms generate would incentivize entry into many, yet today, many of these markets are controlled by one or two key firms. So by engaging with the VC community, as we are today, as AAG Del Rahim explained during his opening remarks, we're hoping to understand the reason for the seemingly durable dominance of these tech companies. Building off some of what we've heard from preceding panels, earlier in the day we heard panelists debate the existence of a kill zone, which, if it exists, may be particularly acute in platform-dominated markets. And we also heard that data, which generates unrivaled value in platform businesses, may also contribute to the creation of significant barriers to entry. So given these apparent challenges, identifying good investment opportunities in platform markets is no easy task. But we are fortunate today to have an impressive group of panelists who will share some of their perspectives on investing in these markets. So let me introduce them. And I'd just like to say, since listing all of their accomplishments would probably take the entire allotted time, I'm just going to mention a few words about each of them, and you all should have the more detailed bios in your handouts. So starting directly to my left is Nick Grossman, who's a partner at Union Square Ventures, where he leads early-stage investment in software-enabled projects. And previously, he led an incubator for startups at the intersection of cities and data. Next to Nick is Mark Lemley, who is a professor at Stanford Law School, where he teaches intellectual property, antitrust, the law of robotics and AI, video game law, and remedies. And he's also a founding partner of Dury Tangri, where he counsels clients in all areas of IP, antitrust, and internet law. Next to him, we have Patricia Nakash, who is a general partner at Trinity Ventures, and where she invests in early-stage consumer and business startups. She's also a board member of the National Venture Capital Association and a lecturer here at the Stanford Graduate School of Business, where she teaches Startup Garage. And then finally, at the far end of the stage, we have Ben Thompson, who is a business, technology, and media analyst. Ben is the founder and author of Stratechery, a subscription-based newsletter featuring analysis of technology and media companies. Ben also previously worked at Apple, Microsoft, and Automatic. And as just one word, I'd like to encourage the audience, both in person and on our live stream, to send questions via email. And then we'll also try to leave time for questions at the end with the mic. So before we get into a discussion about investment, we should understand some of the unique characteristics of digital platforms. And so Ben, I was hoping you could lead us off with that.
Sure. I was at a similar conference to this a couple years ago, and as people talk about platforms, and something about it did not fit right with me, and it's still doesn't fit right with me because it's happening today, and that is implicit in calling all these companies platforms is sort of it comes with a set of built-in assumptions that they're the same, they function similarly, and I'm not sure if that's the case. And so I'm going to focus on two companies, which are Windows and Google. And my contention is that the nature of their power, well, the way it's experienced by companies is very similar. the way they actually attain that power and maintain it, and in the long run, how you might regulate or have remedies are actually quite different. It's important to understand the distinctions. So what the word I use for Google is that it's an aggregator. So I'm going to try, it's funny, even though I say I don't like calling them all platforms, I still fall into calling them all platforms as well. I'm going to try to refer to Google as, in that category of companies, Google and Facebook being the two largest, as aggregators, and sort of Windows and like AWS or Apple's App Store as being a platform. So the big thing about a platform is the word is very descriptive. It is a platform upon which developers can connect with users, or suppliers, maybe another way to put it, suppliers can connect with certain consumers. They facilitate a connection between the two. And what's critical to understand is that they are market makers. Like there would not, like Adobe back in the day on Windows, literally could not serve its customers if Windows was not sitting underneath it, or Mac OS back then. And so they're a critical piece that make the market work. And you just mentioned that, you know, these are important things that are, you know, drive a lot of value, and that's absolutely the case, particularly with platforms. An aggregator, on the other hand, intermediates suppliers and consumers. So if you think about it visually, you have a platform on the bottom, and it props up suppliers, and it props up users, and it lets them have a connection together. In the case of an aggregator, you have a user over here, you have a supplier over here, and the aggregator is sitting right in the middle. And in this case, the reason why they rose up here is they didn't make the market. They made sense of the market. You think about the internet pre-Google, and there was a huge amount of websites out there, and all the stuff that made Google valuable already existed. But how are you going to find all that sort of stuff? Like there were search engines, but they're all terrible, and you could type in a URL or whatever it might be. And when Google came along and said, now you could go to one spot and make sense of this massive exploding array of information that was the World Wide Web. And that was tremendously valuable. Users flocked to Google because it was a superior product that was not just valuable in its own right, it actually had no value on its own. Google was only valuable to the extent that the web was valuable. Well, it turns out the web is exceptionally valuable, and so it followed that Google became exceptionally valuable. And so it helped users make sense about it. What's critical to understand here, though, is the influence and power that Google had came because users chose to go to Google. They went to Google to use it. No one made users use Google. No one makes users use Google today. I mean, you can talk about defaults and stuff on those lines, but the difference is that a user could go to a hotel website directly, or could go to a newspaper directly. They can still type that URL in the bar. Whereas on a platform, if you need that API access, so there's a degree of sort of necessity that is different between sort of platforms and aggregators. And so this makes sense when you think about the potential abuse. You could have a platform that sort of restricts access to APIs or charges a tax if you want to use them. I think the most obvious example these days is Apple's App Store, where to have your app on the platform, you have to abide by their rules. They are leveraging their control of the APIs on their platform to enforce arbitrary rules. By arbitrary, I mean they're not essential for the system to function. Apple decided to put them there, so they are going to be there. Whereas Google, for example, I wrote about this last year, with the squeeze they're putting on the travel agencies, the OTAs like Expedia and Booking, they're putting this module where you search for a hotel, and they'll give you a list of hotels and a map, and all those listings are all ads. So they force Expedia and Booking to buy a bunch of little ads on top of the other ads that they already buy, because the users are going there and looking for it. At the end, what's the way out of it? Well, the good thing for Booking and Expedia is that they can engage in efforts to get the user to go around Google and come to them directly. People go to Google because it's convenient, but they could go somewhere else. A great example of this is 10 years ago, we all paid for Wi-Fi at hotels. Today, most people don't pay for Wi-Fi. Why? Because the hotels figured out, well, if we get them to sign up on our website directly or join our membership program, and the membership program is trivial to join, but the point is, what they're doing is they're using free Wi-Fi basically to get people to go around Google and go around Booking and Expedia, who are kind of mini aggregators in their own right, and connect with them directly. And what's interesting about that is that's actually one example where this aggregator behavior is actually driving consumer benefit, because it is pushing the suppliers that are being squeezed to sort of innovate in a consumer-friendly manner so that the consumer will go directly to them. What's critical is you can't do that on a platform. If Apple decides you're not on the App Store, you're not on the App Store. If Apple decides that Spotify has to pay 30% if they want to have buy an app, they're going to pay 30%. And I think the reason why this is important to understand is you think about remedies. The remedy for a platform is actually pretty straightforward. You force them to open up APIs, to open up the connections. A remedy for an aggregator, understand, is not clear at all because you're dealing not with a restriction on supply, you're dealing with their ability to harness demand. And as a regulator to come in and tell people how to use their computers or how to use their phones, that doesn't work very well. And we saw this with the European Commission where Google, they had the shopping case, and then Google proposed a change, and the commission's like, that sounds great, do that. 6 months later, the commission's like, oh, that was a terrible idea. Who thought that would work? Well, it didn't work because the only way you're going to fix Google's control is by actually getting users to change their behavior, which means either making Google way worse so it's terrible to use, which doesn't sound very consumer friendly, or like making people do stuff they don't want to do and you're like pushing on a string. And that's just different than platforms. And my concern is if antitrust regulations does move forward and we take the Microsoft playbook and think about apply that to these companies that actually their power is accrued differently, then we'll have suboptimal outcomes.
Thanks, Ben. Any reactions to that? Do you all see these markets the same way that Ben has described?
So I do think it's a useful distinction, and one way to think about that distinction is sort of how the competition occurs if it occurs at that level, right? And it's perfectly plausible to imagine, right, two competing Googles, right? And some people prefer one and some people prefer the other. It's plausible to imagine different platforms too, but you've got to buy into the entire ecosystem, right? We have that with phones now, right? If you want to use an iPhone, you're buying into a whole series of ecosystems, and you don't get choices across that level. The one thing I want to note is I think it's I agree with pretty much everything been said, but I think it is worth noting that while there are larger network effects in the true platform markets, right, and benefits to being on or at least connected through the network, there are also network effects in the aggregator markets. They're just of a different type. So some of you might have heard Ram Shriram this morning say, oh, search isn't a network market. I don't think that's right. Right? Search isn't a network market in the same way that telephone is a network market. If you're not on Google, you can't find anything that is in the Google ecosystem. But it's still a network effects market because the benefits that you get, not only by sort of learning what individual users click on, but by what everyone else clicks on, and what the relationship is between people who click on X and people who click on Y, feeds back into the search engine. That doesn't make it a natural monopoly, but it does mean that you're going to get certain systemic advantages by being bigger than or earlier than everybody else.
Yeah. I was just going to say, I agree with the distinction as well. I would say from an investment point of view, one of the things we look at very closely in looking at new investments and for existing portfolio companies is whether there are single points of failure in the business, because single points of failure are bad. And most of our portfolio companies these days do have heavy dependence on the platform and aggregator companies. And to some extent, the distinction doesn't matter in that context, really, because the aggregators have so much
Just
power.
one point that from the supply side, it looks the exact same.
Right.
Yes.
Completely
Yes.
agree.
Well, and I think that you're trying to make a distinction also about looking at them differently from the perspective of, well, how might you regulate them differently? And I think that makes sense. From a startup perspective also, they do sort of look similar, but I think you look at them differently depending on your relationship to them. So in some cases, you're building on top of them, right? Because I need to be on top of AWS or I need to be on top of Twilio and I need to trust it as infrastructure. In some cases, you're using them for distribution. So I need to be in the App Store to reach my customers, or I need to advertise on Facebook because that's how people reach users. And so then you have to think about that sort of dependency. And then in some cases, you're thinking about competing with them. And then that brings up a whole different set of considerations. So I think from the investing perspective, it's also not monolithic. It sort of, you think about the risks depending on your relationship to the bigger companies.
And that's really helpful, Nick, because, excuse me, that's exactly where I wanted to go next. And to maybe turn to both you and Patricia to tell us a little bit about the market features that make for attractive investment. And I want to maybe pivot a little bit with this question based on something that I was discussing with a prior panelist who had explained that you only have finite money to invest in somewhere and to the exclusion of somewhere else. And so I'd love to hear from you all whether there are certain markets that you look to invest in to the exclusion of others, whether it be ad tech, AI, blockchain. So
Yeah.
maybe if you could touch on some of those issues.
Yeah, I mean, look, from an investment perspective, Nirvana is the emerging large market with no competition. Like that's Nirvana, and that's why I think you see it's kind of these mini gold rushes that happen, right? Like self-driving cars, crypto. There's a sort of like testing. Is this the next big thing? And if it is, let's start placing some bets now. And it's why you see, self-driving cars that are really, really early in sort of their evolution. They don't have a product in the market. They'll get crazy high valuations. It's because it's a bet that it's like the next big thing, right? So in this world where, funds have they have a limited fund size and they have to allocate capital, they would much rather pursue, in general, markets where a market that has tailwinds behind it, as opposed to a market that has matured and that has deep entrenched incumbents. That said, there are always exceptions to that rule, and even though there are markets that have been kind of like a bit of a wasteland from a venture perspective, I put ad tech in that category. It's been hard to attract capital as an ad tech startup. There are exceptions. I mean, there's a company called The Trade Desk that has it's focused on programmatic ad buying, and it was started by a person, an entrepreneur with deep domain expertise. I don't think it was easy to attract capital every stage of the way. Company went public's got a $13 billion market cap. They're really thriving. So there are always exceptions, and I think as a venture capitalist, you're always just trying to assess, is this opportunity differentiated enough relative to incumbents? Do I believe in the ability of this entrepreneur to execute against this idea? And if there's sufficient differentiation, you can build an investment thesis. But it's sort of, if you look at kind of the 100% pie of allocation of funds, you're probably not going to give the majority to situations like that.
I think at the beginning, there was this conversation that sort of the antitrust enforcement folks think a little bit like venture capitalists in terms of how much room is there in the market to maneuver and innovate. And I think we've always been extremely sensitive to platform risk in making investments, extremely sensitive. And we think of it as looking for the freedom to innovate. How much room is there to innovate in this space? Who could shut me down? And so, back in the day, before there was the mobile app store, if you wanted to get an app onto a device, you had to go cut a deal with a carrier. We were all worried about net neutrality and whether, every little app developer that had video in it was going to go have to cut a deal with an ISP. Now people are worried about, the app stores and they're going to get cut off. So I do think we're very, very sensitive to that, and we're always looking for ways of finding freedom. And that's why we are personally so excited about the crypto and blockchain space, because that is one area where the platform is an open and unowned, uncontrolled platform. And so, some of the earlier investor comments are talking about, sort of team, product, market. And clearly we think about those things too. I think we probably think about market and platform risk earlier, or maybe more than others might. I think we're very sensitive to it.
And so, Nick, you'd actually mentioned something when we were prepping for this panel that I'd like to come back to, particularly because Ram Shriram earlier had mentioned, if you build something complementary to an existing platform, he said, you're not being ambitious enough. And one of the things that had come out when we were all discussing last week was that there are layers of platforms that may offer opportunities for investment. And so I think what you and Patricia were just describing was sort of looking for the new market, looking for where there's the biggest runway. But I'm wondering if you could tell us a little bit about this idea of layers.
Sure. I'll give you two examples from our portfolio where we looked for an opportunity to create a platform that wasn't encumbered by another platform. So, there are plenty of apps that exist on the App Store that don't have any competitive problem with Apple or Google. They're never going to get shut out of the App Store. An example from our portfolio is a company called Carta, which connects ownership of private companies, we're not worried about platform risk with Carta, yet they are creating a very useful platform layer of the interconnections between companies and investors and employees. And for us, we like that because there was an ability to build a network that was not encumbered by anybody big in the space, and we felt very safe doing that. Another one in our portfolio is called Cloudflare, which is a security company. You hook your DNS for your website into Cloudflare, and they see all your traffic, and they protect you from attacks, and they make your page load faster. Bless you. Yeah, there's a really strong data network effect. It is a platform of sorts in and of its own right. It's an extraordinarily useful product. It went public earlier this year. It's a fantastic company. And when we made the investment, not only did we see the promise in sort of creating a platform at that layer, which is yet a completely different layer than any of the ones we've been talking about, it was clear to us that it was unencumbered. And so I think we're looking at both of those factors all the time.
So I think one thing to note is it's increasingly hard to tell what's in the same market, what's in an adjacent market, what's in a complementary market, and what's in a different market, right? And the person who founded a chain of high-end grocery stores probably didn't see themselves as in a kind of market niche that Amazon would come in and eventually occupy.
But it makes sense now that you look at it.
Maybe the people who founded VR gaming headsets didn't think Facebook would be interested. But you can see the overlaps and the connections, right? And I think one of the interesting things about the growth of some of the big tech intermediary companies is, right, it's not just growth in terms of kind of saturation of a core market, but it's an interesting and organic expansion into markets that may have some plausible connection. Sometimes they don't have a plausible connection, sometimes they're just sort of out there, but may have kind of interesting and previously unsuspected connections, right? Google gathers enough information in its search that might actually position it to write better AIs. If it can write better AIs, maybe it can do a better job of generating self-driving cars,
yep.
Right? There's no obvious connection between those two until you kind of follow through the chain of logic. From an antitrust perspective, I think that's important because we are traditionally very box-centered in antitrust. You are a horizontal competitor, you're in the same market, you're in a vertical relationship, you're a buyer and a seller, or you're a conglomerate, which means to say you've got nothing to do with each other, and we mostly ignore you. And I think one of the problems that the tech space and the intermediaries bring is a bunch of things that don't fit neatly into either the horizontal or the vertical box, and therefore for which we don't have a clear set of rules, turn out to matter, right? Because these companies do have relationships that are potentially going to affect startups, potentially going to affect whether or not you're encumbered, they're going to affect consumers on the back end.
Yeah, I mean, that's one of the things that we look at in terms of single point of failure, which is is a company that we invest in that is going to have some dependency, if it does, on one of these platforms, going to get a fair shake? Like, that's what we care about, right? Like, whether it's in SEO results, whether it's, with the same access to location data on the Apple, yep. on the Apple platform. So that, I think, is incredibly, like, making sure that startups can get a fair shake when they do have a dependency on these platforms, I think is really critical.
And Ben, you made that point earlier about platforms and sort of openness. That's sort of net neutrality, API neutrality. It was the Windows, part of the Windows settlement, right. To open up the APIs.
Yeah, no, absolutely. And I think the one thing that I just want to go back to the point that, I apologize for interrupting you, but the perspective on this really matters. From a supplier perspective, they both, like, Google looks just as evil as Windows. And they're preventing me from reaching my customer.
And their distribution.
That's right, it's a distribution
right.
issue. But if you look at it from, like, a remedy. What's the remedy for the startup? Well, the remedy for the startup, if you need to go through Google, and Google's with you, is you're able to connect with the customer. You need to develop a new sort of strategy to connect with them directly.
So what you do is you buy ads on Facebook so that you can get your own email mailing list, so you don't have to rely on Google.
If you want an email mailing list, you start a word of mouth business with a name that no one can pronounce. That's my approach. But and then the regulatory point also, the way you regulate it is going to have to be different because the way it's going to play out is going to be different as well. But the other thing to remember is the consumer perspective. And what I think is so challenging, particularly someone mentioned last panel with the sort of the U.S. perspective of antitrust and consumer welfare, is it's very hard to make the argument that these aren't incredibly welfare-enhancing companies.
Yep.
All of them. The platforms being large create huge amounts of opportunities, make things much easier to use. Apple adding on features and integrating them together makes it immediately accessible and usable to hundreds of millions of people overnight. And so if you have a small tech advancement multiplied by 100 million, the consumer benefit total is massive. And it's the same thing with Google or whatever these other things. If you wanted to say, oh, some app should be able to be on Apple's App Store and Apple should be able to compete with it, and now that app has to go through Facebook, it has to buy ads, and it's never going to even reach the scale that if Apple just put it on and turned it on. Again, I'm not saying defending Apple in this case per se, but the scale happens because consumers find benefit from these platforms. They all have network effects where the more people that are on there, the better that they are and more useful. And then the flip side of that is the way that the speed with which benefit can be dispersed is just astronomically fast. And so anytime you're bringing in consumer welfare on any of these questions, it gets really tricky to say that there's a big problem here.
But by the way, I would say also that there are a lot of startups that have benefited from these big platforms. Like there are reams of startups that have taken advantage of Facebook's incredible targeted advertising platform.
And now you have independent direct-to-consumer brands that couldn't have existed without
Right.
that.
Facebook is so much scrap and they've done more for it.
So they've grown incredibly quickly and cost effectively thanks to the ad platform. But now they have the single point of failure, right? And as consumers, in many ways, we have a single point of failure. Like we are sort of at the whim. I mean, whether you're a consumer or whether you're a startup, and I think that's the discomfort as an investor we have.
Yeah.
I think consumers, we kind of have it too, I think.
Yeah.
I have a question, Mark. You mentioned this example of every time you're answering a CAPTCHA on a website, you're actually training Google self-driving cars. And on the one hand, you could look. It's true. On the one hand, how many crosswalks do you see in this picture? But on the one hand, that is
Answer quickly because we're approaching the end.
So on one hand, that's really scary because who else could do that besides Google? On the other hand, we may get self-driving cars 10 years faster because Waymo has the best data, because we're all answering, the CAPTCHA. So I find it really hard to make a judgment on it.
And I will say it connects in an interesting way to the last panel too on data and privacy, right? Because, I think a lot of people say, well, gosh, I don't want everybody to have access, all these AI companies to have access to all of my data. But there are companies that, by happenstance, already happen to have really large, good training data sets. Google happens to have already scraped and collected all of the stuff on the web. Right? Facebook happens to have billions of photos that you've posted, right? And so if we don't have interoperability or open API access, right, what happens is, well, the existing winners can get locked in. Right, Google will make better AI because Google starts with a better data set, and no one else can go out and build that data set because they can't go out and build the sort of Google circa 1990.
Yeah, privacy is the best thing that has ever happened to Google Facebook.
Absolutely. Can I? Would it be okay if I put up the pictures?
Yes,
you guys mind?
please.
I'm just because I wanted to just point out a couple ideas, and I really won't dwell on this. But when we think about how we invest around the big platforms, we basically do it in 3 ways. So the first one is this what we think of as vector. So compete on an angle that the big companies can't. So we invested in a search engine called DuckDuckGo in 2011 on the idea who's going to invest in a search engine that competes with Google, except that DuckDuckGo's selling proposition was it's private. And it turns out that you can really build a really big business if you go somewhere where they won't. And now they have low single-digit, market share in search in major markets around the world, and they're profitable and growing. It's has really, really worked. So that's one strategy that we look for. The second one relates to what you mentioned, Mark, about data. So we've invested in a bunch of companies that take the flotilla approach, which is instead of one company like a Google or Facebook sucking in all the data, there are a lot of companies out there that say, hey, all of you little companies connect to us, pool your data with us, and then we'll give you back a benefit on the scale of a Google or a Facebook, but as a collective. So there's a company called Sift, which is an anti-fraud product for e-commerce. Many thousands of websites connect their transaction and user data into Sift, and they get the benefit of Amazon level anti-fraud protection. Cloudflare does the same thing for security. And we've found I like that approach, and we've been investing along that theme consistently for years. And then the last one, which I think is really important, and I mention it because it hasn't come up today, but I think it is fundamental to discussions of competition in the tech sector, is cryptocurrencies and blockchains. Because what cryptocurrencies and blockchains are open source infrastructure for managing data and transactions, which is what tech companies do, and it's also what banks and financial services companies do. But blockchains writ large are an open platform that's not owned by any one company, that is, trustworthy by its nature, and that's kind of the whole point. And so we look at that whole category as, man, this is a solution to to all these problems.
Can I add just
Yeah.
one footnote there, right? Because I think it's not only that it is not sort of beholden to one existing platform or company, it's also not beholden to any one country. And I think one of the
True.
things that we are seeing on the internet is the sort of development of the splinternet, right? China has a completely different set of market leaders. Russia is now building its own, requiring that Russian apps sold in Russia be Russian made, building its own Wikipedia. And I think we're only going to see the kind of increased development of efforts at nations controlling these platforms as well. So the possibility of something that is actually sort of transnational in the sense that it's not just isn't owned or currently subject to one, but sort of can't be in some
Right.
fundamental sense.
And they're
is
open,
important.
blockchain networks are open the way HTTP and SMTP are open protocols. They're just protocols that computers run. And this will be the last thing I show, but we've talked a lot about like the history of antitrust in the tech sector and the government response to big tech monopolies over time. And whether it was hardware with IBM or desktop OS with Microsoft, or now all the focus is on data platforms basically and internet application platforms. If you look back at the history, every time there was government intervention, there was also a technical intervention. So the technical intervention that blew out IBM was microprocessors and open source hardware, and basically like clone computing and open computing that broke the proprietary closed computing. The thing that you could debate whether or not US v. Microsoft was the thing that solved Microsoft's monopoly. I would argue that it's really Linux and the web protocols like SMTP and HTTP that really did it, because you had to have the browser, but once you had the browser, you had this whole other layer. And it's essentially a non-proprietary, open source, unowned layer that was able to pop through and enable blue ocean, free innovation and competition. And now here we are at this next layer where we're having the conversation about, well, what do we do with big tech companies? This is for us where the crypto protocols come in, because they are essentially open source data. And if the big data and distribution platforms are proprietary data systems, blockchain networks like Bitcoin and Ethereum and lots of others are an open version of that they can't do everything that those platforms do, but they can do a lot of things that those platforms can do. And so that's where most of our effort, if you ask us, are we worried about consolidation and market power in the internet today? For sure. And our answer is more on the let's get the next generation of open protocols at that layer, in market and in use, because we think that's going to be the biggest bang for the buck.
I think the other thing to note too with this graph is the reason why the IBM didn't respond to Microsoft didn't respond to Google was not because of government intervention. It's because it was completely different
Right.
business model and approach that they were unsuited to sort of pursue and go after. Not just to pursue and go after, to even see that it was a possibility. I mean, Microsoft's approach to Netscape, they attacked because they thought API. That's what we do as APIs.
Yep.
Google, they had no competitive response, not because they were in a lawsuit, but because Google didn't have any APIs. What was there to respond to? They didn't even conceive of it as a threat. And one thing that's really interesting about sort of regulation and antitrust with the tech industry is there's actually are two regulatory interventions in sort of history that are critical to where we are today. Number one was the settlement with AT&T, where with Bell Labs and having it all be license free.
Yep.
And number two was IBM when they split apart hardware and software. So what's interesting about this is the AT&T decision was roundly criticized, like just way more than people hated it. They could not believe the government let AT&T off so easily, and it turned out that was actually the single most critical sort of settlement that the government has ever done in antitrust as far as tech is concerned. Number two, the IBM one, IBM actually preemptively split up their hardware and software because they wanted to stop the Justice Department from suing them. The Justice Department sued them anyway, so it didn't work. But actually, IBM themselves gave away the crown jewels of their business, which was the integration of hardware and software, because they didn't even realize that was what actually mattered. And the point of this is it's funny, because there's 2 lessons to take away. One lesson is that regulation works. Lesson 2 is no one knows what in the world they are doing, because the 2 biggest breakthroughs were total accidents, and no one involved realized what had happened when it happened.
And there are also business model shifts as
right.
part of each of those. And the one thing I want to mention about why we think crypto assets are so important is that we've talked a lot about the ad business. So the advertising is a dominant business model of the internet today. Crypto assets introduce a different business model where there's ownership of tokens, and the ownership of tokens powers the creation of the network. That has the potential to be a whole-scale business model shift for many pieces of internet infrastructure. Subscriptions would maybe be the other one that I think a lot of us are investing along. But I really wanted to make this point. We don't need to dwell on it, but I just feel like if this conversation about competition didn't cover the potential of blockchain networks and crypto assets, I think it'd be missing something fundamental. And my last bit on it is just that the way that we think about crypto assets specifically is that they take on some of the functionalities of financial intermediaries and data intermediaries. And instead of running those through companies like Google or Facebook or JP Morgan, they run them through protocols which are open source and not owned by anybody, and transparent and rules-based. And there's been crazy advances in cryptography, a lot of them on this very campus, that have made this possible. And then this sort of new business model of crypto assets, crypto tokens, is driving a lot of this. And the thing that I think may be the most impactful for helping competition on the internet would be to facilitate the evolution and nurture this whole set of technologies. I'll get off my soapbox
Well,
there.
just
so
to
thank
double
you.
down on that, I mean, there's no way Google or Facebook can go into this, because it destroys their core business model. Just like Microsoft was going to go into search engines. I mean, because it just, they thought licensed software, that was their business model. Just like IBM didn't go into the PC business because it was too low margin, and licensing to OEMs didn't make any sense. We do a fully integrated, full stack subscription. People forget IBM actually invented subscription pricing years and years ago. And I think this business model point is underappreciated. It's easy to brush aside and say, oh, well, they can just do a different business. No, you can't do a different business model. Like, that's core to how your company got as large as it is, achieve the stock price that it did, and the mindset of the executives in it. It's a critical part of why these companies don't respond to these sort of shifts.
Maybe just one more comment on this topic.
No, that actually
yeah.
leads to, we're going to do an exit strategy next?
Yeah, exactly.
Yeah, exactly. I think this leads quite nicely to sort of what I wanted to talk about. And this is the part where sort of our happy agreement goes away and we become the skunk at the garden party. So I think all of what you've been hearing about is consistent with this idea of Schumpeterian competition, right? So it's not that we didn't have dominant players before, it's that you have a dominant player and then they are blindsided out of nowhere by a new technology that isn't just sort of a direct competitor that came up and did better, but a kind of adjacent company that no one really thought of as the problem or a threat, and then suddenly they become the thing, right? Software takes over from hardware, Microsoft misses the internet, and the internet just sort of takes over from operating system platforms. It doesn't drive them out of business so much as it kind of makes their business less important. What I think is worrisome in the modern platform/intermediary environment is we seem to have stalled that Schumpeterian competition. Right, if you think of who the dominant tech companies are that everybody talks about and worries about, they're all more than 15 years old, right? Facebook is probably the youngest, right? But Google, Apple, etc. Microsoft still hanging on pretty well.
Bitcoin is 10 years old and has a $230 billion market cap. So there's
right. Well, so but Bitcoin might be the new right. And I acknowledge Nick's argument that sort of Bitcoin might come and serve this purpose. It hasn't yet. But 15 years is an eternity in internet time, right? And so what's going on? Andrew McCrary and I have a paper called Exit Strategy. And we actually tie some of this to the way Silicon Valley finance happens, right? So the venture capital model has done an amazing number of things to drive tech and innovation, but the venture capital model is based on the idea that you start a company thinking about how you're going to end it, right? I need an exit strategy, right? My VCs need to get paid. The traditional kind of goal for exit strategy was the IPO. It still is to some extent. That's even if you can get an IPO, that's great. But some of the evidence we saw from Susan this morning, and there's a lot more in our paper, suggests that IPOs are fewer, they're bigger, and it take longer to get to them. Right, so the idea that your kind of new tech business is going to start to do well, get an IPO, that gets its more momentum, and it stays in business as a working company. That doesn't. It's not that it doesn't happen. It's that it happens a lot less now than it did 10 or 20 years ago.
With the exception of the crypto markets, where projects launch and are public very, very early on.
Well, and they're right, and that may be right, and you know that would be great. And if it disrupts, then it disrupts, and that's great. But in most of the sectors, that's not what we're seeing, and overall, that's not what we're seeing. Right? We're seeing quite a substantial decline. So VCs want to get paid, right? The founders who are getting paid largely in stock want to cash out too. How do you get paid if you're not going to have an IPO? You sell the company. Well, who's going to buy your company? Well, you can imagine various possible folks to buy the company, but I'll tell you who's probably going to buy your company, right? And that's the dominant incumbent. Certainly if you're a direct competitor, but even if you are in one of these sort of market adjacencies, right, which could be the next thing that comes in and takes it over. Right? So why is that? Well, they have huge amounts of money. Apple's sitting on $250 billion in cash. They just don't know what to do with it all. They have the incentive, right? Because how do I hold on to my existing market share? One of the things I need to do is make sure that there isn't some new tech coming out of nowhere that's going to take over or destroy my market. And often they have the best information, right? They might be able to know the market well enough to know and identify the companies that might be threats and buy them up. And so that's exactly what happens. They buy up, Google and Facebook alone have bought up hundreds of companies. And some of those companies get the benefit that Ben described, right? Suddenly I was a small company and now I can reach all of the users in Google or all of the users in Facebook, and that's great. But a lot of them don't see that. A lot of them get shut down. Some of them I think are bought and shut down deliberately. But some of them are bought and shut down as acqui-hires. Where I didn't actually want your company at all, right? What I wanted was to get you to come work on my self-driving car project because you're a brilliant AI mind. Some of them are bought and shut down even if I really intended to implement them because the cultural fit doesn't work, because the company that buys it is never as interested as the startup that was running it in kind of making this happen, because priorities shift, because there's not an immediate bottom line payoff and so forth. So I think I think the result is that we are actually reinforcing concentration in the tech industry in a lot of these areas precisely because people want to get paid. The way they get paid is sell the company more often than not. And who do you sell the company to? You sell it to the incumbent. So I think we need to break that cycle, and we need to think about how we break that cycle.
Patricia?
Yeah.
I know you're dying to respond.
So look, just the mindset I think when investment is initially made in a company is like plan A is glory, right? Plan A is you are going to build a standalone large company that has the potential to go public. So the ingoing assumption and the reason you make the investment is because that is your objective. There are very few companies that reach that threshold. I mean, look, the fact of the matter is most startups fail. That's the brutal truth, right? Most startups fail. Entrepreneurs know it, venture capitalists know it. So, but the whole reason entrepreneurs take on this incredible risk is because there is enormous upside when a company does have the potential to become standalone, or plan B, get bought, right? So I'm very nervous when we talk about potentially putting friction into what is a very important liquidity outlet for entrepreneurs and for investors, by the way. I mean, capital has options. Venture capital turns out to be a very tiny asset class. US venture capital is even tinier. Capital has options of other places to go. So I think we have to be very careful about not changing the economic dynamic there. So anyway.
Well, I'll add. I mean, certainly Plan A is go big and go public. And if I look back at the liquidity events, the exits we've had over the last 6 or 7 years, far and away the biggest ones have been IPOs. There have been 6 or 7 IPOs in our portfolio in the last 6 or 7 years. Those returns make our funds. To the extent that there have been acquisitions, it's not exactly that it's a rounding error on the fund, but it is it's fine. But if the IPOs produce the biggest returns, full stop. And I think certainly, so I don't think almost any company that I talk to, it doesn't start out saying, oh boy, I hope Adobe's going to buy me, or I hope Facebook's going to buy me. Now, sometimes that's how it goes, and sometimes those acquisitions can be positive for the founders and okay for the VCs. Sometimes, the big companies treat it as sort of outsourced R&D and a way of bringing, innovations that couldn't happen inside their walls,
In fact, Cisco's famous for that. Somebody put up that slide earlier in the day, and Cisco was top of the charts with nine acquisitions,
Right.
I think over 500 million.
And it's a great innovation strategy if you can do it. And so I don't know, I'm not arguing that there are potential concentration problems with acquisitions, but for certain, the mindset of venture-backed startups is not, let's get acquired.
Oh, no, I agree with that. Just to make clear sort of where we agree and where we disagree, right? I think that's right. And I think part of the issue is, right, we've made that sort of exit to glory harder, right? And it takes longer and fewer companies can do it, right? And that's driving more of the market into the acquisition space.
And into the crypto space.
So crypto. So the reason I think that you keep coming back to crypto is as different may be that there isn't an obvious incumbent for whom
Well, and there are liquid markets now. I would argue
that might
that
make it different.
we have the opposite problem in the crypto markets, where projects, early stage projects, have listed tokens on exchanges in the U.S. and elsewhere, and so they're facing the pressures of public markets and liquidity and ups and downs and all that, when they don't even have product market fit yet. And so on the one hand, in regular companies, you've got companies like Airbnb and Uber that are staying private forever. And in the crypto land, you've got things that are public, and they're like seed stage products, but they're publicly traded assets. And so it's kind of wacko. But
I actually think there are some kind of regulatory reasons why that space in particular started going public earlier. But on the kind of broader point, right? I guess what I want to emphasize is that sort of what makes sense from the VC and maybe from the founder perspective in the short run isn't necessarily aligned with the social interest, right?
Well, but let me just stop you there, because I think what I worry about the most is the unintended consequences of imposing restrictions on M&A. Because if what we're trying to do is encourage competition, what I worry about is if I'm a founder or I'm an investor and I'm thinking about starting a company in a core market of a large incumbent, but I know that down the road, if plan A doesn't work, plan B will not exist for me, that changes the tips the scales. And so I just worry the unintended consequence of going down this road is less competition, because it becomes even less attractive.
And that's why I think you need a combination of carrots and sticks, right? So I think what I want to do is actually not just say, hey, regulate these mergers more, although I think that is part of the package, right? But I think that's got to be coupled with sort of ways to make sure that we are in fact encouraging innovation in this space. That can be, right, easing some of the restrictions on IPOs, making IPOs easier. It can be, and Joe Grunfest talked about this morning, right, making a better and more robust secondary market pre-IPO so that founders and investors can in fact cash out and get paid even if the company doesn't go public. So that's not the only alternative, right? So I think you need a kind of balanced package of things to try to encourage.
We've also got portfolio companies that are flipping into more of a dividend mode,
right.
where let's find some long-term patient capital that's willing to step
exactly,
in here
right. And it might not be
buy
venture,
us out.
Right?
Yeah.
It might not be
but that's a big win for us,
right.
but it's a version of a plan B that's not an acquisition.
Exactly right, and the significant difference between that version, right, or the secondary market version and the acquisition version is do we end up with a freestanding company? And I think right now the risk is that a bunch of successful, not home run yet, maybe never home run, but successful companies that are profitable, right, end up getting swallowed up and either destroyed or kind of built into the board, right, when we could actually have some of those companies operating in freestanding market. And if we have some of those companies operating in a freestanding market, one of them is going to turn out to be then sort of next adjacent market changer. We have no idea which one, but if we don't have those companies out there, we're not going to see that Schumpeterian competition.
Yeah, just, I think it's really, really important here to have a distinction in acquisitions. And I think I've been guilty of this personally, where what looms large over the acquisition discussion is Instagram.
Sure.
And the reality is 99% of acquisitions are not Instagram. And we look at Instagram and say, oh my God, how did we let Facebook buy that company? And we think, we gotta stop this. And what's gonna happen, to your point, the unintended consequence, the casualties could be just absolutely massive. And I think, like you even mentioned a few, like an acquihire, no acquihire is a successful company. Those are failures. They're every single one of them. And it's actually to the benefit, this is a great service these companies provide the Valley, where particularly not just the entrepreneur, but the startup employees who would be unemployed otherwise, they get an easy soft landing into a job at Google or Facebook.
Right.
And that makes them more likely to leave Google and Facebook again to do something
Exactly.
else.
So we have one for my portfolio where a company got acquihired essentially into a large private company here in Silicon Valley. They became the in-house machine learning team in one department. They did a bunch of good work. They stayed there for like 2 years, and now they're like brewing on new startup ideas. And I guarantee that same team comes up with a new startup that they'll launch.
So why
coming out.
acquihire and not just cherry pick?
What do you mean?
I mean, so right.
Because entrepreneurs feel obligation to their employees and to their investors. By the way, usually in acquihire situation, investors are, if they're lucky getting their capital back, usually it's a partial return on capital, sometimes no return on capital.
Right.
But they're sort of saying, look, I feel some obligation to all my stakeholders, and this is a soft landing. And maybe the technology that we build will have some life going forward, right? And so it's way more attractive.
Yeah. No. Right. And so I think you're right that Instagram is not, is most of them are not Instagram. Although there are a bunch of other sort of acquisitions like that. WhatsApp is, I think, an interesting
We'll see.
example in that space as well. But I think it's right to distinguish between like companies that succeeded, companies that failed, and companies that we don't know yet for sure whether they would succeed or fail, right? And in the failed company case, right? Absolutely, acquisition is a great exit, right? And that's been true and recognized in antitrust law more generally, right? Not just with acquihires, right? But we saw, whether you agree with it or not, right? The T-Mobile Sprint decision yesterday, the merger was allowed because the court concluded Sprint wasn't going to make it on its own. And if Sprint wasn't going to make it on its own, well, then we do want those assets to go back to productive reuse. If we thought Sprint was going to make it on its own, though, we'd rather have 4 competitors than 3, I think, in most cases.
Well, there's another thing to think about this here, just to add on to categorization, is there is much more license to do a pure tech startup in a world of acquisitions. You don't need to worry about having a business plan or a go-to-market and actually like building a company. You can literally go out and just build super cool tech, knowing that they're going to be fighting over you. And you'll get acquired, and not just that, then you get the benefits of being dispersed to customers much more quickly. And so, again, you could say, well, wouldn't it be nice if someone built amazing vision tech and then they built a whole company around it and IPO and be a competitor? But there's a time aspect here where building a company is really hard. And so we're saying, no acquisitions. If you want to build cool technology, you also be good at business and build a good business. And I think there's a lot of benefit that comes from startups being able to not have to build companies, but be able to build features. Like that's actually great that you can start a company that is basically a feature, and you have a shelf life, and then you go somewhere, but that feature got built, and that's a good thing.
I agree with that, but I think that one of the things Silicon Valley ought to be able to do, and has in the past proven able to do, right, is to combine good business people with good technologies in a way other than the incumbent has the business, and so the technology goes to the incumbent. right? So that can be VCs pairing up good business teams, right, with good tech teams. That seems to me that's what VCs are basically best at. It could be having a good business team that's not actually the dominant incumbent player acquiring. Right? So acquisitions that are not acquisitions by incumbents seem to be something we ought to treat a lot more generously than acquisitions by dominant incumbent players.
Well, sometimes it's a crappy business.
So that's
Like,
also possible.
If you're want to sell hardware, like you could have the best business people in the world, and you have a very, very steep hill to climb. Particularly if you want to do a hardware feature, like a camera or something like a detail of it. And I think it's just you know more about the companies in the data set than I do. I have a hard time accepting the idea that there's all these would-be successes but for the acquisition. Again, I think it's the Instagram effect. We see Instagram and maybe YouTube going back further, and we're like, man, wouldn't the market be better if Instagram were to make a company? And I think it absolutely would be. And I think the returns are actually huge to that, because an advertiser would not just have to serve another company, they'd have to develop a more modular advertising system, which would benefit tons of other companies. Like, if Instagram could be independent, it would be wonderful. But just because there's that one example, we have to be very, very careful that we react to that one example and then just obliterate the market and opportunities for the 99% of the other examples.
Right, I agree. Hey, just to go back to one point we were talking about earlier, which I think we are in violent agreement on, which is sort of making it easier for companies to go public. I just wanted to go back to that for a second, because I know that I think somebody who was up in an earlier panel sort of made the comment of, you talked about the decline in IPOs. And actually, the number of public companies is dramatically lower than it was, a decade ago. I mean, there's only 4,000 public companies today, and only about 130 go public every year. She made the point that we are better off without these smaller IPOs, but she was referring to companies with a market cap of less than $100 million. So I just wanted to flag that, because that is very low end of the range, and today it's actually hard to go public if you're going to have less than a $1.5 billion market cap.
Yep.
So I feel like there's a lot of room to move, between 100 million and 1.5 billion.
Right, and those aren't failed companies,
No,
right?
they're
Right,
not.
the companies that are valued at something over 100 million, when they're getting acquired, right? It's not that they've failed and they have to, and maybe some of them, but a lot of them are in fact ones that are could actually potentially be doing quite well in a market in a different.
But just the cost of going
Yep.
public, the litigation that happens all too frequently when you go public, the lack of research coverage if you're a small market cap company, I mean, all that sort of conspires against companies taking that path.
I think there's also a fair bit of acquisition activity by what I would consider to be sort of non-technical incumbents. So a big insurance company, or a big payroll company, or a big bank, or and I've seen acquisitions in the $100 to $500 million range that are bringing like software into companies that suck at software. So I don't know that that's bad either, right?
Yeah, it could be good or bad. I mean, I think some amount of that is actually aimed at preventing regulatory disruption. So there was a discussion on an earlier panel about, right, not just sort of the idea of sort of market barriers to entry, but a lot of industries are regulated in a way that make disruptive competition harder. And technologies that disrupt the incumbents in those areas are particularly problematic for those incumbents, because they actually have built an environment in which the government barriers make it easier for them to avoid competition. The taxi industry was like that, right? The hotel industry was like that. And if you can sort of make sure that there's not an Uber or Lyft or Airbnb for your regulated industry, you can hold on to a pretty lucrative monopoly.
That's actually a great seg into our next question or topic, which is the role of sectoral regulation. Some people say that regulation has the effect of fossilizing an industry, and I guess I'm wondering for all of you, and we've heard a lot, particularly in the context of platforms, whether they should be regulated. And so as we're talking about investing in markets that are dominated by platforms, my question for you is, do you agree that this is creating challenges, or could it also create new investment opportunities?
So I'll get this out of the way real quick, which is, I think the sort of state of like crypto regulation, securities laws, specifically in the United States, is one of the biggest challenges to that sector. It's a new class of technologies. It doesn't fit neatly into existing boxes. The use cases are not really well understood. And all of the major activity is happening in Asia and outside of the US. And so for me and for us, that is like way at the top of the list of areas where sectoral regulation is causing problems for the tech industry and for this problem we're talking about. And I think the other one that's on my mind has been discussed today, which is like privacy. And I worry that increasing privacy regulations will just make it harder for startups and entrench the big companies with existing distribution and ability to get consents from users. And I think that has more or less borne out with GDPR in Europe. So those are the two that are the bees in my bonnet.
I mean, compliance is costly, and the cost, the proportionate cost, I think, to a startup is a lot higher than to a large established company. And I think I was sharing with you that in financial services has been documented that, companies with revenues of under 100 million, their cost of compliance is like 7.5% of their revenue. Whereas if you look at financial service companies with between $1 billion and $10 billion in revenue, it's like 2.7%, right? So it's just a dramatic, when you think about, cost structure of a startup, it has a dramatic impact.
Another industry example, I think, where this is significant is the content industry, right? So if you build a tech company that interfaces with content, the copyright owners will come for you. They'll do it in the United States, but they will do it even more so in Europe. And under the new European regulations, the European Parliament said, well, just do what YouTube did, right? Which is to say, spend $150 million to build a system over 10 years that is pretty good at, not perfect at, but pretty good at filtering out content and distinguishing copyrighted from uncopyrighted works.
And by the way, is a hotbed of anti-competitive abuse.
Absolutely.
Because people put in fraudulent takedown requests for content they don't like, for competitors they don't want to see.
Right.
And YouTube and Google comply with that to be safe.
Absolutely, right. And so, right, exactly. So it's going to be, if you're a startup, right, you could invest all of that money, right, and it's going to be harder, it's going to make your life harder when you do do that. Now, there are good reasons to have copyright laws, right, and we want to enforce those copyright laws, but I think the more we build sort of sector-specific regulation aimed at this technology, right, the harder it is to actually develop a startup as opposed to an incumbent, right? So what we end up doing is entrenching the people who got there first, right? I mean, YouTube didn't start with a content ID system. If YouTube had to start with a content ID system, it wouldn't exist, right? Now, I think it's good that YouTube exists, and it's probably good on balance that they've got some sort of filtering system. But the idea that therefore any company who wants to come into this space must have an equally good filtering system is a real barrier to startup entry.
Yeah, we are back to being in violent. And I thought Mike made the point this morning that YouTube was begging. It's absolutely true. They're begging for acquirers. Like, why did they sell out? Like, because they were under such legal threat.
Right.
And the reason why Google got a lot of skepticism about that deal is you
bought an $8 billion liability.
You're right. You bought a lawsuit. And so in the European, what direction the European Union is going is mind blowing in its what a terrible effect it's going to have on competition. But I think the point to keep in mind here, what the shame about the privacy debate, in my opinion, and I'm maybe a bit of a contrarian on this, is so much. I think it's so overblown in many respects. The dangers, right? We heard the comment last panel that data is the new oil, which makes no sense if you actually think about it for 4 or 5 seconds. One big reason is the reason why Facebook and we'll take Facebook because they have the best data in the world. The reason why my data is so valuable to Facebook is because they have the entire infrastructure to make sense of that data. And even individually, it's not everything, but it's the entire world all put together, right? And so they have the way that the advertiser walk up. I want to reach, a male in the white male in his 30s in Taiwan. Maybe that's a little too narrowly focused, but they can accomplish that. It's all the infrastructure that has to be built first that makes the data valuable. And this, by the way, is why Instagram is, for the record, vastly more valuable by virtue of having been bought by Facebook than it would be as a standalone company, which is something that's worth keeping in mind. But my data by itself, if I had my data and I walk up to you and say, here's my data, how much do you give me for it? The answer is 0. It is not fungible in a way that oil is fungible. And the other thing is people have this in their mind, oh, Google has Facebook has this data on you, right? And they picture like the East German Stasi and like file cabinets and stuff, and so they're gonna go in and look at my data. Like, you don't scale to that level with pieces of paper in a filing cabinet. You scale to that level by it being this unintelligible primordial sort of soup where I'm represented in Facebook as like a vector calculations that you would have to literally go in and spend months trying to build something if you actually wanted to get this.
So let me take the flip side of that. So in the UK, they have this thing called open banking, right? So which says that if you have a bank account, the bank has to open up an API to let you export your banking data to someone else. And this is a version of data portability and interoperability that is mandated. And it has led to a good interoperability and explosion of new banking products that can, by law, by right, plug in and suck the data out from over here and do something with it. So I agree with you that if Facebook gave me all my data today, and I've downloaded my data from Facebook, you can do it, I don't know what to make of it. But I think, and this ties into the point about like the burden of compliance, I think data portability is one of the most interesting vectors for compliance because any startup could comply with it. They're already built on top of APIs. And to add an API that a user could extract their data at their own choosing would be trivial for a startup to comply with. And you could imagine, and this is your point, another company coming in, nicksawesomeDataCompany.com, and I will be your data advocate, and I will plug into your Facebook, and I will plug into your LinkedIn, and to your Google, and I will extract all the primordial goop, and that is unintelligible, but guess what? I'm gonna build a whole software team, and all they do is data mine your own data for you, but guess what? I work for you, because maybe you pay me a monthly subscription. I'm just imagining this. And so I think there is utility and value to be had in aggregating personal data around people, and I think that it is one of the ways that we can increase competition that's relatively simple and straightforward relative to
so let me just, because I think because this is an antitrust conference, let me sort of loop that
Sure.
Back to antitrust, right? Because I think it fits in a very sort of surprising and uneasy way with antitrust. So I think there's a lot of kind of general sentiment out there that big tech has monopolies, big tech monopolies have all this information and data on us that gives them an advantage. We need to sort of use antitrust as a tool to break that out. If you think about what that would actually mean using traditional antitrust tools, right? What it would mean is more data portability, right? Sort of more companies should have more access to my data for less money. We should have a more competitive market in which people sell my data for advertising. I think that's actually
in which case I take the data and provision it, and not that they're all just moving it around, but that I can do with it what I want.
We will create a variety of different things. I actually think that's probably a better world than the one in which we have. It is the opposite of the world in which most of the privacy advocates who suggest using antitrust are asking for, right? And so it is worth keeping in mind, right, when we talk about antitrust and privacy, right, that there is what antitrust wants to give you, which is competition and new startups and a bunch of different things, maybe the opposite of what privacy regulators actually want to give.
Yeah, we are, again, I think primarily in agreement. I think a point. Well, I just want to address your one point about the bank thing. It's very discrete, distinct data.
No doubt.
And so you know what to do with it.
Yep.
Whereas the data Facebook has on me is very not discrete. It's just a mess.
But if I had a 100-person software team and all I did was data mine on people's Facebook data, I could make sense of it.
Okay, you're making my point, right? Your software team is going to put forth a lot of effort and value to make that data valuable.
Yes.
The point of this is that Facebook is valuable not because it has data. Facebook is valuable because they put forth the effort to build the infrastructure to make sense of that data.
Absolutely.
And so sure, I'm all for data portability as well. I think the privacy, and this is my point, the privacy thing is definitely for competition, and the shame of it is no one's actually protecting anything. Like it's a red herring in so many respects.
I think that's actually a really nice point to end on because I want to make sure that we leave some time for questions. I know you all were looking forward to some audience questions, and we only have a few minutes left. But I just like to open it up and see if anybody has. I think there's a mic that will. If you could go to.
Thanks. I think I'm going to direct this at Patricia, though anybody can jump in. I was going to ask, I know you testified before the Senate Judiciary Committee, I think, earlier in the fall, and maybe it's related to the conversation about regulation, but just generally, what do you think legislators, as distinct from other DC actors either get right or get wrong about this conversation? Like, where are the gaps from your perspective as people, and I'm thinking in particular of members of Congress?
Yeah, so look, what was a pleasant surprise for me is that I think there's kind of bipartisan appreciation for this kind of special ecosystem that we have in the Valley in particular, but kind of broadly, and an appreciation that, you know, we don't kind of want to kill the golden goose, right? That it's a job creation engine, maybe not as many jobs as some people would like, but it's a job creation engine, right? It generates public companies, et cetera. So that was a pleasant surprise. I think there's a lot of still education, and I guess what I worry about the most is this whole notion of unintended consequences, that with the best intentions about trying to drive competition, which I think we would all agree, you know, there's just no argument there. We want to drive innovation because it's been a real powerhouse for the US economy. But let's do it in a way where we don't, let's make sure that we don't do it in a way where we unintentionally actually introduce a drag on it. You know, like if you look at the share of venture dollars deployed in the US relative to globally, it's declined over the last 20 years from 90% to 50%. Now, the pie overall has grown dramatically. So it's, you know, the venture dollars have grown in the US, but I'm just thinking as a share globally, it's declined. And, you know, if you start introducing a lot of friction into the system, like, you know, maybe restrictions on M&A, but, you know, also if you look at immigration, you look at CFIUS, it all starts adding up, right? And sort of starts putting real guck in the wheels. So
Okay.
Yeah, I was going to say, I'm very nervous. I think there is a very strong bipartisan sentiment to do something in Congress about big tech. And the worry in Congress is, right, what you often want Congress to do is nothing. Right, and nothing, don't just do something, stand there, is actually often the right way to think about it. It is not the way people in Congress think about it. And there's some really bad ideas floating around in both sides of Congress right now, from let's abolish Section 230 and get rid of the ability for platforms to actually control the content on their own network, to my personal favorite, which is, we have this problem of these algorithms that are sort of measuring and tracking your behavior. Ben doesn't think it's a problem, but we think it's a problem. So there's a proposal from Senator Thune that we should just have any company that uses algorithms should just offer a non-algorithmic alternative. And there was a great conversation on Twitter about what a non-algorithmic search engine would look like. The best answer of which was, I'm picturing a computer that is turned off.
I'll add one thing, which is I think the one bill we're probably most excited about is the Access Act, which is coming from Warner's office in the Senate, which is about interoperability and portability, and that's I think where we think there's a lot of promise.
Thank you. I think we have time for one more audience question. So, I think, we'll just wait for the mic. Yeah.
Where is it going?
Along with regulations on interoperability and access to data from healthcare systems, what your thoughts were on access to data within government databases. So data sets at NOAA, other types of data that could be easily anonymized and otherwise just shared with APIs on competition. So either faster data exchanges with agencies, NHTSA too, and thoughts on platforms.
I want people to have more access to government data and government to have less access to people's data. That's the short answer. I do think there are a lot of things you can do around existing or could be built government databases that help get at some of this interoperability problems, particularly for AI, right? Maybe we don't need to sort of force Google to share all of its data. If there is a set of data that NHTSA has or something else, somebody else has that could be the basis for building a sort of AI to train self-driving cars, for instance.
And you just mentioned healthcare. I think there's been the recent debate around Epic pushing back against HHS, wanting to open that up. And I think it's a perfect example of the frustration where privacy has provided a club for companies to be extremely anti-competitive.
Yep.
And that is like the best possible example where it's your health data. Of
My
course
health
you
data.
want it to be private. And meanwhile, Epic just has a complete stranglehold on that entire industry.
I think that's a perfect note to end on. And not that anyone needs coffee after this dynamic discussion, but we will not keep you from it. So before, I would just like you to join me in thanking our panelists for a great discussion.
Thank you.